Okay, let's take a look at the journal entries in Chapter 2. Now remember, when we are looking at the journal entries, and I'm starting on page 81, if you want to follow along, keep in mind that when we write out journal entries, journals, the general journal, is where we actually record the journal entries for the first time. Now keep in mind though, when you actually key journal entries into the general journal, nothing has actually been affected out here on the balance sheet and actually in the accounting records. Okay, so the general journal occurs outside of the accounting records. Where the general journal then ends up affecting the accounting records is when we actually do this posting process, where we take that general journal, we go down through, we take out all the cash items, we take all the debits to cash, and we put all the debits over here on the debit side in cash, and then we take all the cash credits and we put all the credits over here into the cash. So again, as the general journal is built, it's built in chronological order, but it actually does not affect the balances in the accounts. It doesn't affect the balances in the accounts until we move those debits and credits from the journal into these specific accounts that are being affected in the general ledger. Okay? So let's take a look at transaction 1. In transaction 1, we issued common stock for $12,000. So the first thing that happens is cash goes up by $12,000, right? And that cash increase has to be coded to something as to what caused that increase. So we come over here to common stock issued. Remember, common stock issued, right-hand side of the equal sign now, we're going to go up on the right. So we do $12,000 credit to common stock. Now notice what happens after that journal entry is posted. $12,000 in assets, 0 in liabilities, $12,000 in owner's equity. Okay? Okay, let's take a look at the next journal entry. We borrowed cash. So in this particular case, again, that cash goes up by $3,000. Then the reason for that cash increase is we borrowed it. So we come over here to the liability side of the balance sheet. We find the notes payable and we increase notes by $3,000. So notice what happens after both sides of that journal entry are posted. We have $15,000 in assets, $3,000 in liabilities, $12,000 in equity. All right. Transaction 3, we purchased equipment using cash. So in this particular case, the cash goes down by $4,500, but in this case, we simply converted that cash to another type of asset. So we come over here to property and equipment, and we increase property and equipment by $4,500. So notice what happens here. We had a reduction in cash of $4,500. We had an increase in property and equipment by $4,500, so assets continue to be $15,000. All right, transaction 4. Now in transaction 4, we're purchasing insurance. Now one thing that you have to remember about insurance is we buy insurance in advance. So in this particular case, we're buying a 6-month insurance policy for $1,200 in cash. So intuitively, I think you understand that we are using, or it's costing us $200 a month for that insurance over those 6 months. But we pay the $1,200 in advance, then we will use it up as the months pass by. So keep in mind, accrual-based accounting says that we have to record the expense in the period in which it's incurred. So at the day that we actually pay the insurance company, there is no expense incurred. If, let's say, a day later we decide that, or even the same day, we decide, okay, we want to cancel this policy, we're going to get back that $1,200, okay? So almost at first, it's almost like we take $1,200 and we put it into a savings account, and as that savings account gets used up over the months at $200 per month, then the balance in that account will actually decrease. So in this particular case, we're going to go back over here to cash. Cash is on the left-hand side of the equal sign. We need to decrease cash, so we're going to decrease it on the right. Okay. So $1,200 there. Again, those prepaid expenses or prepaid assets, they're actually going to increase by $1,200. Okay. Now, again, that's prepaid insurance. So notice what happens up here with assets. Assets are still $15,000. We simply shifted one asset into the other kind of asset down there in the prepaid expenses. Okay. Let's take a look at transaction 5. In transaction 5, we're purchasing supplies on account. So essentially, we bought it at Hamilton Office Supply. So we walked into Hamilton and we said, okay, we need $6,500 worth of supplies, put it on our tab. So when we put those supplies on our tab, we actually took the supplies home. So we actually have those supplies in hand. So we increased supplies by $6,500. And then, because we told them to put it on our tab, we now have a liability to Hamilton of $6,500, and we have to put that in the liability section of balance sheet. So notice what happens now. Assets are $21,500, liabilities are $9,500, owner's equity are $12,000. Okay? All right, let's take a look at transaction 6. So in transaction 6, we had a sale of services for cash. Now, before I go over transactions 6, 7, and 8, I want you to get a feel for what's happening here. In 6, 7, and 8, all three of these items are related to revenue. But I want you to get a big picture view of what's actually happening here. In transaction 6, we've got a sale of services for cash. So we earned the revenues in the same period that we actually collected the cash. In transaction 7, we had a sale of services on credit. So we provided the services, so we earned the revenue, we get to record the revenue, but the customer has not paid us yet. So we put a place marker out there in accounts receivable so that we know to collect that at a later date. So we earn it today, we collect it later. Then in transaction 8, we've got a receipt of cash in advance for revenues that we will earn in a later period. So in transaction 8, it's the opposite of transaction 7. In transaction 8, we collect the cash first, then we will provide the services later. So again, review of 6, 7, and 8. 6, we collect cash and earn the revenues in the same period. Transaction 7, we actually earn the revenues but don't collect the cash. In transaction 8, we collect the cash but we don't earn the revenues yet. All right, so let's plug these three transactions into our T accounts and let's see what happens. All right, so transaction 6, we're going to increase cash by $8,800. Okay, and we earn the revenues. So go over here to the revenue section. We need to increase revenues. Revenues increase on the right, so we've got an increase of $8,800 in revenues. So now we've got assets of $30,300, liabilities of $9,500, and owner's equity of $20,800. Right? Transaction 7, now we earn the revenues again. So we've got $3,300 in additional revenue. So now revenues are up to $12,100. But we didn't collect, so we go over here to accounts receivable. We increase the accounts receivable by $3,300 because we're going to collect those later. Okay, so now assets are $33,600, liabilities $9,500, equity $24,100. All right. Transaction 8, we're actually earning, we're collecting the revenues, but we're not earning them. So now we've got to go over here to cash. We collected the cash, $9,000, but we didn't earn those. So now we've got to go over here to the liability side. Under unearned revenues, we now owe the customer the services, so we increase those unearned revenues by $9,000. So now we've got assets of $42,600, liabilities of $18,500, and owner's equity of $24,100. Okay. All right. Transaction 9, we've got the payment of a liability. So now we're going to pay off some of those supplies that we purchased previously. So we have to write a check. So we've got a decreased cash, $6,000, and we decrease the accounts payable of $6,000. Now let's walk this through. We originally bought $6,500 that we owed. Okay, we now paid off $6,000. So now accounts payable is now showing a net balance due of $500, and we'll take care of that at a later date. All right, transaction 10, we've got the collection of a receivable. So this receivable down here of $3,300, we actually collected $3,000 of it. Okay, so we reduced the account, we increased cash by the $3,000 we collected. We reduced the accounts receivable for the $3,000. So remember, we sold $3,300. We've now collected $3,000. We now have $300 left to collect. Okay. Transaction 11, we've got payment of salaries. Now, the other thing, let's look at transaction 11 and 12. So in 11 and 12, we're paying the expenses, and the assumption is we're paying them in the same period in which they are actually incurred. Okay? So at the same time that we are reducing cash, we're increasing the expense. So in transaction 11, we reduced cash by $1,800. Okay? That was the payment of the salaries. And now we come over here to the expense section, and we increase expenses by $1,800. Now watch what happens here. We increase the expense by $1,800. We currently have a balance of owner's equity of $24,100. As soon as we enter that $1,800, equity goes down. So now we've got $34,800 in assets, $12,500 in liabilities, and $22,300 in equity. All right. Same thing for the payment of the utilities. We're going to come over here. We write the check, $5,200 in reduction of cash. We come back over here to the expenses. Again, pretend that they've got their own T account. Again, we just don't have enough room there. So again, notice what happens. As this expense increases, watch what's going to happen to the owner's equity balance. Owner's equity balance now goes down to $17,100. So now we've got assets of $29,600, liabilities of $12,500, equity is $17,100. Transaction 13, we have the payment of a dividend. So again, we come over here to cash. We reduce cash by the amount of the dividend, $500. We increase dividends down here by $500. Now again, watch what happens. As dividends increase, the balance in equity is going to decrease. So $500 increase in dividends, $500 decrease in equity. So now, at the end of these 13 transactions, we have a balance of assets of $29,100. We have a balance in liabilities of $12,500. And we have a balance in owner's equity of $16,600. Okay? So, at this point, we've posted all these, this whole thing of step 3 is posting to the ledger. That's what we just did. So you can see how this spreadsheet shows you what the balances change to as we enter the information. So let me just give you a quick overview and a little scroll down on what each of the individual balances look like. And there you go. All right. So there is chapter 2. So at the end of this, we will put together a trial balance. All right. So at this point, you can see if we skip over to page 86, we are now going to put our trial balance together. So each account is going to show its net balance. So you can see we've got a net balance in cash of $16,600. We've got accounts receivable of $300. We've got supplies of $6,500. And we've got prepaid insurance of $1,200. And we've got equipment up here of $4,500. So we list each one of those. Each one has a net debit balance. Then we come over here to the liability section. We've got $500 in accounts payable. We've got, let's see, $9,000 in unearned revenue, okay, right here. Then we have a $3,000 note payable. we've got a $12,000 common stock balance. Then we've got dividends of $500. We've got revenues of $12,100. And then you can see here, I've got them totaled together, but you can see on the trial balance, each one of those different types of expenses will have its own balance. So you can see that if we balance debits and credits, we now have a total of $36,600. So when we're looking at the trial balance tells us that each one of those debits and credits that we had written out in the general journal got posted correctly as debits and credits into the general ledger. So keep in mind, though, that just because the trial balance balances does not mean that we can verify that each individual balance is correct. So let me show you what could happen there. So let's say, let me give you an example here. All right, let's go down here to accounts receivable and supplies. I'll keep it right there. All right. So this particular credit that was posted to accounts receivable, and we should have a balance in accounts receivable of $300. If this credit gets posted accidentally down here to supplies, okay, and not here, okay, we still have a balance in assets of $29,100. But each individual balance here, this one is overstated by $3,000. This one is understated by $3,000. So debits and credits are still going to balance, but it does not mean that the individual balances in the accounts are correct. So once the credit gets posted to the correct account, we now have individual account balances are correct, as well as the asset balance is correct and our trial balance is correct. So you always have to make sure that each individual debit gets debited to the correct individual account. Each credit gets credited to each individual account. Okay? All right, so there is a little summary of Chapter 2.